Welcome to the Capital Discussions Road Trip Trade Alerts weekly update. I'm Tom Nunemaker with Dan Harvey. And I was on my own road trip this week in Paris with my wife. We just got back about an hour ago. And boy, we had a great time. And I really love this trade because I was monitoring it while I was in Paris on the iPad and not too much to do. So that's kind of the idea with the road trip. If you don't want to do all the layers and just keep it simple, you can and not have too many adjustments, especially when you're traveling.
Yeah,
So
it's very
it's nice to
nice.
be back, Dan.
I mean, it's road trip on the road trip, and Tom sounds very relaxed, doesn't he? I think he does. So he must have had a good time, and I think that's great because he works hard and he deserved a little vacation here. And
Yeah, we walked.
I would imagine Paris. Well, I know because I was there a couple of years ago, and Paris this time of year is great.
Oh yeah, the weather was outstanding. I did get a couple of blisters walking around so much, but you know, two pairs of socks and some band-aids on the blisters took care of that. So,
Yeah.
and we were back in action.
There you go.
So, I did all the like I was telling Dan when we were talking before we started the recording. I've got all the images done, so we're just going to go through those. It's a bit quicker than bringing up option view every time. And you can see I've got the profit all set and the comments for Dan's Monday plan. And so we're going to start with the Russell, and then we'll go through the SPX. So the first Russell we've got is the one you see, which is the October 21st expiration. And you can see the probability of touching on those short strikes is almost zero. So this trade is we got the line by the tail, I think, on this one, Dan.
Well, I think so. And the money, if we make any more money, which I would hope we make a little more, it's actually probably going to come from the layered butterfly that I added on as opposed to the original butterfly. And in fact, I'm thinking about beginning to unwind the original butterfly. And I'd like to be out of this thing in about 14 days. And we'll take whatever we can get. My main concern, of course, is if we continue to rally, I'm going to have to do a fairly aggressive reverse Harvey to get that expiration line above zero because I don't want to lose money on this trade.
Right. And you do have quite a bit of room on the upside, but like you said, if it rallies, then this is below zero, so it is slightly negative delta. You can see. So definitely keep an eye on it, and we'll show the next Russell trade, and then we'll talk a little bit about what we were talking about with do we want to keep doing the Russell. So here's the November 18th Russell trade, which is also looking okay. It's up $152, a little bit over 1%. Still lots of time to go. I've got a T plus 41 line here that's kind of highlighted. And if we do pull back, it'll make some really nice money. But, the markets have been kind of up and down, so it could keep rallying.
Right. So the same situation here. If we, as Tom said, if we pull back, this will do very well. If we stay the same, it will do reasonably well. But if the market keeps ratcheting up, we're going to have to address this fairly quickly. It's not an emergency, but we've got to get that expiration line above zero because that is one of the main tenets of the road trip trade is to not lose on the upside. But at the same time, of course, we don't want to do it too quickly and have the T plus zero line sloping down, which it obviously is not now. So we can be fairly aggressive on this if we need to be.
Yeah, we're slightly negative delta, -8 with a plus 25 theta. So, we're making money every day. But, if the market does keep going up, then it's definitely going to have to be adjusted. Now, that brings us to the point where we've been talking about the Russell, and you notice this one's up $152. The other one's up a little bit more, but the Russell definitely hasn't been performing as well as the SPX. And I know, Dan, you've been looking at the ES futures options as an alternative.
Yeah, they actually seem to work quite well. They're the pros and cons are, at least in my mind, go something like this. The advantage of the Russell is, and as a matter of fact, the reason why we offered this trade is because you can get in if you have a small capital account. You can do the Russell. and you can make a little money, but it does not do as well as the SPX. The premiums are not as good. Uh, in my in my view, it's not as liquid. It's harder to get a fill. So for this type of trade, now there are other types of butterflies which, in which the Russell performs fairly well, but actually sometimes even quite well. But for the road trip style, in which we don't want to lose money on the upside and we want to be very conservative, we don't want to lose any money at all if we can possibly help it. Nobody else does either, I know. But we don't really, we have very, very few losses in the road trip trade, and we wanted to maintain that kind of profile. And so the road trip style works exceedingly well for the SPX. It works for the Russell, but you don't make as much money. I mean, it'll work on some stocks. It'll work on lots of things, but you have to uh, weigh the relative risk and reward and merits of the trade, in terms of how much money you're making. And so if you do the E-mini futures, uh, or the ES I'm talking about in particular, the E-mini, the ES. So those are the mini futures options on the S&P 500. Those are going to behave fairly similarly to the SPX. It has a pretty linear volatility smile curve, very liquid, lots of strikes, span margined. So the downside is that you have to get a futures account, which is usually pretty easy to do. Just request your broker to let you get a futures account, and you might have to fill out a little paperwork. But the road trip graphs look almost identical, as you might imagine, to the SPX. So that's what we're considering.
And we'll do a poll just to make sure that, if we do make this switch, that it's something that you guys want. So we're not going to just do it, without asking what you actually want to do. So don't worry about that. We'll get your opinion first.
Right. And if we decide to do that based on the polls, we'll do a little WebEx to show what the graphs would look like. Obviously, they'll be very similar. The only major difference that I've noticed is that trading the E-mini futures options, you have to get a little bit closer to the money to get the curves the way the way that you want them to be. But that's a minor thing, and we can certainly do that. And both Tom and I are very good at trading futures. I think we've been doing it a while, and futures options as well. So we would like to think we know what we're doing, right, Tom?
Absolutely. And one benefit, too, with the futures options is you can trade the underlying. So that's another nice thing about the futures options trades.
Well, that's true.
All right, so let's switch over to SPX. I think the next one we've got is the 21 October, which should be on the screen now. So we've got a nice profit on this one, Dan, up almost 6%. And it's running out of time. It's still got 28 days left, but we're kind of getting into the target expiration range pretty soon.
Well, that's right. And so I was looking at this and studying it, and I want to get this out of here fairly quickly and lock in our profit. Obviously, if we had a pretty good pullback, we could make some really big money. And of course, that's always nice to have double-digit returns. We do get them periodically, but the way the market action has been moving, which we'll talk about later, we went through a big resistance line recently. We're right at the 50-day moving average, and we could keep powering forward. And I don't want to give up this profit, and I don't want to spend the next few days or 2 weeks doing constant reverse Harveys. I may do one or two, but I want to I want to keep this money.
Yeah, it looks like it's going to be a solid winner. All right, I think that's it for this one. Let me go to the next one, which is our 31 October SPX trade. This one again is up really nicely. It's up over 8% with over 38 days remaining to expiration. So again, this is kind of like the last one, a big pullback, and we have a nice profit. So um, obviously, don't want to lose on this one. This is up so a good amount already, over 1,100, and that is the close of Friday.
Yeah, this one worked great, and I didn't even have to layer anything. I didn't really have to do much on this one, and sometimes you have to make several reverse Harveys, which we'll talk about in later on after we go through these, because we had a question from Dennis regarding this, and we'll address that. But sometimes you don't have to do much, and we didn't even have to layer this one, and we just need to make sure that we don't, continue to drop towards that expiration line. So one or two more reverse Harveys might be in order, but again, we don't want to give up money on this guy either.
Yeah, we're still positive theta, which is great. So the family of curves, they're not quite compressed here. So I can see why you haven't reversed Harvey quite yet, because it's still going up, which is the right direction.
Right, and we're making pretty good money. I mean, the theta to delta ratio is about what, 5, which is pretty good.
Yep. All right. So the next one we've got is our 18 November trade. Again, this one's looking in great shape. Theta is strong, delta is low. Probability of touching that short strike is 41%, so it's still fairly high. So maybe a little early to do any more reverse Harveys for the newer traders. Again, we don't want to get this too positive delta. Just slightly negative is this is really good at -2. But it's up 2%, still lots of time, so really not much to do except let time decay do its magic.
Right, I would agree.
All right, so the last one is the new trade, the 30 November. Let me pull that one up. And again, this one was just put on Friday, so it's very very young. It was just brand new, so not too much to do. Obviously, not you just put it on, Dan. So maybe you want to talk about the strikes. You notice there's a lot of gaps in here, so you don't have all the same strikes you do as say the December monthly expiration.
Right, yeah, this is the Wednesday expiration, and I'm sure some people might say, why did I choose that? And I chose it because of the open interest. For the regular weekly with uh, that expired on the 24th or something like that of November, um, it had the usual strikes, but the open interest I thought was very weak. So I would rather, go with the 25 multiples and make sure that I had good open interest, make it a nice wide butterfly, uh, knowing that I can do more with it because of the open interest than to uh, be stuck in something like a roach motel kind of trade where you get in but you can't get out. And probably as time goes on, they'll open up more strikes on this. I'm pretty sure that they will. But when I launched it, they basically had only 25 multiples. And Dennis, I had mentioned in one of the posts that we might be leaning a little bit long delta, so I might have to add an out of the money debit spread. And Dennis was asking, what does that mean, and why would you do that, and how would you do that? So uh, so I didn't do that because I didn't really have to. But the purpose would be if you're leaning a little long delta and your T plus zero curve is sloping down right at trade launch, which it's not now. But what I mean by sloping down, if you were to draw a vertical line from the short strike, and if the T plus zero were sloping down at that point, then that I don't like to start a trade that way. So I was thinking about and looked at the possibility of adding a single out of the money debit spread with the long leg of the debit spread the same as the lower long leg of the butterfly. And that just serves to raise this up a little bit and get you off to a better start. But I didn't actually have to do that. So that's what I was
Yeah,
talking about, Dennis.
this actually looks really nice. So it's you didn't even have to do a reverse Harvey like you had to recently. So
No, I didn't. No, this
this is
looks
a good
good.
looking one. Yep.
Yeah. And we're starting off with once again a good theta to delta ratio, which
And it's a
for
little
the
bit
newer
below the
people,
money.
well, it is, yeah, which is good. And so just for the newer people, if because I think we've had some people sign up recently, the theta to delta ratio, you simply take the theta, which is the daily time decay. So that's the money you would make every day if nothing ever, if nothing else ever happened. That's the money you make every day. So you take the theta and you divide that by the absolute value of the delta. And I see I was looking at the wrong one here. Actually, it's about 5, but it's still pretty good. So in other words, you disregard the sign of the delta. So a roughly 25 divided by, we'll say roughly 5. It's a little less than 5, which for a trade starting out is actually very good. I need to have at least 2.5. So this
So
is
there we
pretty
go,
good.
4.3.
So I think that's pretty good, don't you, Tom?
Oh, it's excellent.
Yeah.
So you're basically you're minimizing the price risk for the amount that your time decay is raising this up. So the gamma is really low, and the lower the gamma, the flatter the curve. And you can see this is very, very flat. So this is
Yeah.
perfect starting road trip. And I like that it's so far below the money. So, SPX, the screenshot was 2164, and the upper longs at 2125. So that's already 40 points below just to get here. And if you're talking about down this range, say at 2008, it looks like the downside expiration is or break even. That's 158 points away. That's a huge move.
Well, that's right. And one of the reasons that I picked these, I mean, I didn't have a lot of choices, but I could have gone up a strike. But I purposely chose this because, just like you said, Tom, it's far out of the money, but yet uh, the metric that I use for the upside, namely 1.5% above trade launch at expiration minus 15, that still met my criteria. In other words, there would still be some profit, even if you never did a reverse Harvey. If you go out to expiration minus 15 at 1.5% above trade launch price of the SPX, what is the money you would make at that point, and then express that as a percentage of margin. And I've shown this metric in the past, and this one did pass that. So I thought it was a pretty good combination of still being able to make money on the upside without doing anything if we had to, and yet the short strike is a long way below the money. So we have a lot of downside wiggle room, which is important because, as I said, we're back at the 50-day moving average of SPX, and we just now blew through a major resistance line. So, which would have been, let's see, so that would have been like around 2100. See, well, maybe 2125. There was a pretty good resistance line
Up
there.
here.
Yeah, going back through last year.
Yeah,
I
down
mean, all the
here.
way back here. Yeah, and that was the line I was looking at, and we blew through that a little bit, and then we kind of consolidated, then we pulled back and gapped down, as everybody knows, but then look what happened. Then we set a new support level, um, once again roughly at 2125, which has now become support, and now we are back up again, and we're at the 50-day moving average again. And if we were to blow through the new upper resistance of whatever that is, 2190,
Up
or
here.
no, maybe, yeah, right there, whatever that is, then we're off to the races. And uh, so that's that's what could happen on the upside. But we could also hit that resistance and then start to drop again and blow through our support. And then if that happened, we would be glad that we had a lower short strike on this one. That's the point I was making.
Well, especially with news like North Korea threatening to wipe out Seoul. So,
Yeah.
that could spook the markets, and boop, down we go again.
Yep.
So
Yep.
then it's nice to have all this room down here. So I think this is a great looking trade, and like you said, it passes all the tests, and it's very safe. Lots of room to the downside, so this is great. I love this one.
Well, right. I think that's it, isn't it?
I
So,
think so, Dan. So it's
so
great to be back. Got all my
well,
computers with my multiple
yeah.
screens.
Well, we're glad to have you back. Actually, Dennis had two more questions that I can cover very quickly.
Oh, sure.
So if you would go back to uh, the the price chart, yeah. Dennis asked, noted that I had done 6 reverse Harveys on the 21 October, and I went back and looked, and indeed, yes, I have, which is more than I usually do. So he was wondering why is that? We launched that trade on the 2nd of August, and I did a reverse Harvey on the 16th, the 22nd, 25th, 30th, the 7th of September, and the 22nd of September. And there was a reason for all these, and the reason is we kept moving up. From the 2nd of August, we kept moving up. And uh, you can't, you can't wait, forever. Now, usually I don't do the first reverse Harvey until nearly 30 days after, but I did this one a little earlier because we had moved up quite a bit from the 2nd of August and showed no sign of dropping back. And and we do these very gradually. We never did drop back. We just sort of consolidated there, and I just kept watching the curves get more and more compressed and dropping closer and closer to the expiration line. So I figured I better get that expiration line up. And then around the 20 or the 7th, we dropped back, and then um, uh, no, I'm sorry. Then what is that? Maybe September
The ninth is we had to sell off.
the 9th we had to sell off. But then after that we started picking up again. So
Great.
I needed to reverse Harvey it again. But the net result of all this, as Tom showed you, is this trade is making good money. So the commissions are pretty cheap on doing these reverse Harveys. Yeah, it's kind of a pain in the butt, I guess, but yeah, do you want to make, $1,400, $1,500, or there's no free lunch, right, Tom? And
Yeah.
so better to be safe than sorry. So that was my rationale for doing this. So I hope that answers your question, Dennis. And then he had one other question that basically dealt with when I layer a trade. The two that I usually use are either a condor or a small lot butterfly. And when I do the condor, sometimes it'll be unbalanced. Like there may be three, we'll say, put spreads and only one or two call spreads or something like that. And so I do it like that to be able to fix up the position deltas a little bit, in addition to bringing in more premium. And we know about the layered butterflies because people have seen those. So I think part of his question was, how do I decide which is which? And the answer would be, it depends whether I need to fix up the total position deltas or not. It depends on how much margin that I have available, because I do try to keep the margin within our guidelines. And thirdly, and perhaps even most importantly, which one is going to give me the best expected return. And Tom, if you could show where that is on option view, what I look
Or
at for the expected return on the the graph.
let me. And that was the 21 October.
Well, yeah, it doesn't necessarily have to be that one. I just wanted to show where that
Oh,
was.
right. This right here. It's
Yeah.
expected that
So
ER is expected return, and
right,
PP is probability profit.
right. So for those of you that already have option view, obviously we would hope you know what those numbers are and how they're derived and what they mean. Anyway, when I'm making a decision, and probably Tom does the same thing, of what to add, we look and see which one is going to give us the best expected return for the least amount of margin. At least that's the way I do it. What about you,
Me
Tom?
too.
Yeah,
Yep, I always look at that when I'm evaluating adjustments.
yeah. So those are the answers to your questions, Dennis, and thanks for asking.
Yeah, and if anybody, if you have any more questions, feel free to post them in the forum or use the Ask tab on the members site. So I really appreciate everybody staying with us and helping move the road trip trade along. So it's been a fun journey so far, Dan, and look forward to a lot longer series of road trip trades in the future.
Well, same here. One of our subscribers made a little joke and said, made note of the obvious that I'm a bit long in the tooth, which of course I am, but I, plan on doing this for a long time, and I'm not of the James Dean School of Philosophy. You remember James Dean, Tom?
I
Uh,
do. Hmm.
yeah, the basic philosophy: live fast and die young. Well,
Right.
no, I that's not. I'd rather be long in the tooth. I've had a long and full and rich life and did everything I wanted to do, and I'm still doing everything I wanted to do. So I don't mind being long in the tooth.
Well, I remember the saying they taught us: there's old pilots and bold pilots, but no old bold pilots.
Exactly. Yeah.
All right. So with that, it's again great to be back, and look forward to another exciting week of trading. So thanks again, Dan, for all that you do, and thanks for keeping things going while I was on my personal road trip.
You bet.
So,
And thanks, everybody.
all right. Take care, everyone.